SmartFination checking in. Quick update on my X profile. SmartFination handle is where the action lives. All key links sit in the description below. That space delivers instant vault figures, comics news, and big macro moves as they unfold. No lag time, no cuts or filters applied. When precious metals shift direction, you get notified first there. Skipping the follow means you stay one step behind the curve. Jump over now and lock in your access right away. Here's what I'm asking from the group today. Write SMART in the comments area below. Tell me your pick. Which precious metal leads Q1 performance, gold or silver? Your honest forecast helps me measure how sharp this community truly is. I recorded this segment on January 29th, 2026. What follows might sound completely unreal at first. Silver just touched a historic peak, over $120 per ounce in Western trading zones. Meanwhile, Shanghai Futures Exchange saw silver reach 31,099 yuan per kilogram, $139 per ounce exactly. No error in those numbers. China trades at $139, while New York holds $120. That leaves a striking $21 per ounce gap between Shanghai and COMEX. Now the really alarming development begins here. Perth Mint and Metalor, two giant silver refiners globally, have completely closed their doors to new silver intake. Not a single fresh order accepted from anyone. Argor Heraeus plus Nader face extreme order piles, pushing deliveries into April and May windows. Wholesale surcharges exploded 200% over the past 2 days alone. Bullion Star issued a statement yesterday confirming they now hunt aggressively for any leftover silver still circulating. Let's connect these warning signs together carefully. When did a $21 spread ever persist between the planet's top two silver markets without traders rushing in to capture it? When have premier mints shut down new business simultaneously like this? Such events never appeared in modern tracked history. Not in 1980, not 2011, never. Shanghai Gold Exchange Daily Bulletin from January 29, 2026 shows silver closing at 30,891 yuan per kilogram, up 8.51% in one session. That equals roughly $138.25 per ounce on conversion. Gold settled at 1249.12 yuan per gram on Shanghai futures, 5,590.20 per ounce, up 7.88%. But pay close attention to this vault statistic. SHFE silver stocks plunged 26,360 kilo during a single trading day. That removes 26.36 metric tons, or 5.2% of total inventory overnight. Compare that to the prior weekly SGE report from January 19, 23, showing only 1,130 kilo withdrawn over 5 days. Yesterday's withdrawal alone dwarfed that weekly figure by 17 times. This surge goes far beyond fleeting speculation or hype. Physical silver exits, exchange vaults at an escalating speed, while paper contracts struggle to reflect the reality. Current readings show a clear break between physical reality and the paper pricing mechanism entirely. Consider carefully what a sustained $21 premium really indicates. In normal conditions, traders would buy low in COMEX at $120, ship east, sell high at $139 in Shanghai, and pocket easy profit. That classic arbitrage pattern should erase the spread fast. Yet no meaningful flow happens in either direction. Physical movement stays blocked or severely restricted. The Shanghai markup signals distorted pricing, not simple excitement. Physical silver delivered in China commands $21 more value than any paper commitment promises in New York right now. Turning to the chart view for confirmation, technical signals strongly support the fundamental pressure building underneath. Silver cleared its old record high, took a short breather, then launched into brand new price territory above all prior ceilings. Volume distribution highlights thick accumulation zones between $90, $100, pointing toward heavy institutional and possibly sovereign buying activity. The 21-day moving average now sits firmly at 97 Mahler, acting as reliable dynamic support well above levels unthinkable months ago. Still, genuine downside threats deserve honest discussion, because ignoring risks in heated markets often proves costly. CME and COMEX hold power to hike margin requirements sharply, a tactic that crushed momentum rallies in the past. Back in 2011, silver peaked near $49 before 5 margin increases. In 9 days, triggered a steep collapse afterward. Western central banks might coordinate swap facilities or emergency leasing programs to calm the surge. We simply don't know yet. This run could mark a classic blow-off peak ending violently, wiping out most participants who joined late. Chinese regulators could tighten capital outflow rules quickly, shrinking the Shanghai premium almost overnight. Algorithm-driven momentum might reverse abruptly if broader risk appetite suddenly flips negative. Full clarity on COMEX, warehouse levels, and LBMA vault contents remains limited. Undisclosed off-exchange supplies could flood back unexpectedly. These form serious counter-arguments worth weighing carefully. Anyone promising endless upside from here sells optimism, not facts. Determine your own risk, comfort level, holding period, and clear exit triggers before committing fresh capital at record price territory. Yet a powerful bullish argument has strengthened dramatically despite those hazards. Perth Mint and metal ore halting intake signals no minor glitch. These century-old refiners maintain vast supply networks worldwide. Both stopping simultaneously points to a major structural rupture. Bullion Star confirms wholesale premiums doubled or tripled recently, not a passing squeeze. That reflects a deep repricing of actual metal versus paper claims. Argor Heraeus and Nadir quote 3 to 4 month waits now. Late January today means refined silver from Europe faces long delays. We witness a genuine supply chain breakdown unfolding. Mine production offers almost no quick response to higher prices. New silver mines require 5 to 10 years from discovery to output. Most silver emerges as byproduct from base metal operations. Short-term supply elasticity stays extremely low. Shanghai's 26-ton daily vault drop proves physical demand in action. Manufacturers, governments, or institutions claim and remove metal outright. Silver Institute data shows industrial consumption hit fresh highs in 2024-2025, led by massive solar panel manufacturing worldwide. China's solar rollout alone consumes hundreds of millions of ounces yearly. Once embedded in panels, that silver stays out of circulation for decades. This ties directly into wider monetary trends unfolding now. Gold at $5,600 in Shanghai with an 8% daily gain tells a bigger story. Both metals soaring together alongside vault drains and mint halts signals eroding faith in fiat currency systems broadly. Tangible scarce assets gain revaluation against endlessly printed money. China has built gold reserves strategically for over a decade already. Silver quietly rose to strategic status thanks to its irreplaceable role. In energy transition technology and high-tech manufacturing inside China, China dominates large portions of global silver refining capacity. Recent export curbs on key silver compounds reinforce that position further. A nation restricting outflows while domestic prices surge 20% above global levels demonstrates intentional accumulation, not random inefficiency. The persistent $21 Shanghai premium sends a loud message. In a hyper-efficient, algorithmic world, such a gap should vanish instantly. Its continued existence proves physical arbitrage has broken down completely. Refined silver simply cannot reach China in needed volume at prices Western sellers currently accept. That situation declares the paper price in New York largely fictional now. True price discovery, the level where real metal actually trades in size, lives at $139 in Shanghai and keeps climbing higher. Bullion Star admits they actively chase whatever silver still exists anywhere. A top-tier dealer scrambling for physical supply confirms the crisis depth. The tangible market has fractured in ways rarely seen before. Looking ahead, several logical paths could develop from here. Path 1, explosive top forms followed by 30 to 50% correction. Weak holders dump. Prices stabilize $70 or $80 range for 6 to 12 months. Path 2, sideways grind, settles in near current levels. Silver oscillates $130 while supply slowly creeps toward demand. Path 3, shortage intensifies into outright unavailability. Prices rocket toward $150, $200 or beyond as paper credibility collapses. I hold no crystal ball on which scenario wins out. What stands obvious, the risk-reward equation shifted decisively. Buying near $30 6 months ago offered strong asymmetry. Purchasing at $120 today carries higher downside exposure for similar upside potential. Long-term holders from lower levels face their ultimate test now. Secure massive profits or ride through turbulence? Partial sales with runners or full commitment? No one-size-fits-all choice exists here. Plan any profit-taking moves ahead of time. Price targets, triggers, everything. Write them clearly and honor them without emotion. New entrants at these heights face elevated risk with thinner safety margins. If the supply deficit story remains solid, gradual averaging beats lump sum entry. A correction rewards patience. A straight shot higher still delivers gains. Counterparty danger looms largest of all right now. Paper silver, ETFs, futures, unallocated pools equals a promise, not possession. In severely strained markets, that promise can quickly lose meaning. If top mints reject new business, existing paper holders may struggle badly. COMEX futures carry force majeure or cash settlement risks in extremes. Nickel on LME faced exactly that precedent in 2022. Silver holds similar vulnerability under pressure. 3 core messages stand out clearly. Physical and paper silver markets have split apart functionally. A lasting $21 gap with no arbitrage proves price leadership shifted to physical. Refining and minting chains suffer unprecedented bottlenecks right now. Perth Mint, Metal Ore, Argor, Heraeus, Nadir all report extreme constraints. This marks structural revaluation of real metal versus contracts. Vault withdrawals accelerate sharply. 26 tons gone in one Shanghai day. Large players extract metal from exchange systems at record pace. Western intervention remains the wild card hanging overhead. Authorities historically restrained metals, rallies through policy coordination. Yet severe physical shortages sometimes overpower every containment effort. We operate in unprecedented territory at present. Perform your own thorough research always. Consult qualified advisors who understand your exact situation. Weigh carefully the dangers of buying peaks, holding paper claims, or sitting out if a major monetary shift begins unfolding. No painless paths exist, only calculated trade-offs ahead. Available evidence, fresh reports, and market mechanics all converge toward a historic turning point in precious metals. Whether peak or launchpad, coming weeks and months will tell. This remains analysis of public data and developments only, not financial advice in any form whatsoever. Your capital decisions belong entirely to you alone. Trade thoughtfully with reason, never hype. Smart Fination out.